that note, let's cut across to Alok Agarwal, the CFO of Reliance Industries. So speaking about the results of the company that came out just a short while ago, I'm just going to see if we can cut across to that. Yeah.
Pleasure to welcome you all again to the Reliance quarterly results presentation. This has been a good quarter for us, and we have two new records which I want to share with you right in the beginning. Our standalone profits at 7,702 crores are a new record. In many ways, it shows the power of integrated business model that we follow. Our second record is a quarterly EBIT in petrochemical segment, which at 3,417 crores is the highest ever. Our consumer businesses are also gaining traction and have done well. As I will talk about later, retail has had a magnificent growth in revenue at over 8,000 crores. And as you all know, Jio has acquired over 16 million customers in less than a month of its launch. Let me now step back and briefly review the macro environment that Reliance operated in. First thing is that we now have a better commodity price outlook than we did when I was here with you a quarter ago. While Brent prices have averaged about $46 per barrel during the quarter, roughly flat compared to the previous quarter, they now trade above $52 per barrel, and which is more than 50% up from the bottom. Henry Hub gas prices averaged $2.8 per million BTU, nearly 45% higher than the average for the previous quarter. They now trade at about $3.25 per million BTU, roughly twice of what they did at the bottom during 2016. So both oil and gas look decidedly better now than they did a quarter ago. Exchange rate with an average of just under 67 for this quarter and the previous quarter has been remarkably stable for the past 6 months. When we look at oil demand, we think that 2016 will be between 1.3 to 1.4 million barrels per day, after a very strong 2015 at 1.8 million barrels, and forecasts for 2017 continue to be encouraging at between 1.2 to 1.3 million barrels demand growth. Coming back and closer to home, India has also seen very strong demand growth across all our products. In as far as refined products are concerned, we have seen 8% demand growth in the first half compared to the first half of the previous year. This demand growth is led by gasoline and aviation fuel, which are both up roughly 11% as compared to the previous year. Diesel is a bit softer at about 3%, but we have to keep in mind that this includes the traditionally weak monsoon period. All leading indicators for product demand look encouraging. If we look at vehicle sales in India, they are between 6 to 12% higher across various categories. And if we look at the aviation miles that are being recorded, they are in excess of 20% as compared to the previous year. As far as petrochemicals are concerned, we are seeing strong demand growth there also. Polymers recorded a demand growth of 11% for the half year as compared to previous period, led by PVC with a strong 20% growth year on year, coming on back of demand from construction household products. Polyester had a more modest 6% growth, but the second quarter was strong with 14% growth, and PET leading with 28% year-on-year demand growth. So key message there is that not only have we seen strong demand growth come back in India, we have also seen that across all our major categories. With that, let me move and talk about our financials. Revenue on a standalone basis is up 8% quarter on quarter at 64,344 crores. Behind this sequential increase in revenue is primarily volume growth, both in refining as well as petrochemicals, and also to some extent a higher level of absorption within the domestic markets. PBDIT remained flat quarter on quarter and I will talk about the segments of refining and petrochemicals offsetting each other in a few minutes. Net profit, however, increased 18% year-on-year and 2% quarter-on-quarter to 7,704 crores, which, as I said earlier, is a record for the company. As we sweat our existing assets for cash while we are simultaneously investing in new projects, our return on capital employed unadjusted is nearly 11%, but adjusted just for manufacturing assets is in excess of 20%, in fact nearly 21%. This is the highest return on capital that we have seen in a long time in our energy and materials business, and also reflects the fact that we have among the best operating systems as well as best systems in refining and petrochemical in the world. It also demonstrates, as far as this quarter is concerned, the resilience in our earnings model, where a softer refining environment has been offset by a better petrochemical segment performance. On a consolidated basis, our revenues are up 14.3% quarter-on-quarter at 81,651 crores. As you will appreciate, the difference in revenues between standalone and consolidated are primarily due to earnings from our retail business. Our consolidated earnings are virtually flat, just up 1% quarter-on-quarter, and as you know, the difference between earnings on standalone and consolidated is primarily because of our upstream shale business in North America. Consolidated capital expenditure during the quarter was 17,000 odd crores as compared to nearly 27,000 crores in the previous quarter, and the key message here is that our capex cycle is declining as we get closer and closer to commissioning all our projects. Net debt was under 1,07,000 crores as compared to 96,000 crores in the previous quarter. With the financials behind us, let me now talk about our refining business. GRM for this quarter was $10.1 per barrel, $5 per barrel spread over Singapore complex. For the first half year, the GRM is $10.8 per barrel, which is at par with what we had for the financial year 2016. Put this performance in context, our outperformance against Singapore complex for the last 5 years has been $2.50 per barrel. So in the last 2 quarters, when we see a performance of nearly $5 per barrel, it clearly shows that we have, through our operations, significantly outperformed even what we were doing earlier. When we look at production, volume was 18 million tons of crude processed, among the highest that we have ever done, and roughly 5.5% higher than what we did in the previous quarter. Margins for us at $10.1 per barrel were higher than all global benchmarks. As a reference, when we look at Gulf Coast refining in the US, $8.3 a barrel, European refining at about $4.50 per barrel, and Singapore complex we talked about before at $5.1 a barrel. We also made progress in our expanding our retail footprint in India and opened additional gas stations, which are now 1,100 operational as compared to 1,022 in the previous quarter. If we look really at what happened in the refining business, product by product, diesel margins were stable, in fact average slightly higher than the previous quarter from 10.5 to 11. Naphtha was softer, primarily because of cracker turnarounds and some feedstock optimization. And gasoline continued to be soft and dropped from about $14.50 to under $12 a barrel in this period, essentially because of a lot of refineries having switched to gasoline mode and exports from China. In this environment, to maximize our earnings, we really took care of 2 things. We switched to making more diesel than what we had done earlier instead of gasoline, which helped us in terms of better margins. And we also optimized on both our operations as well as risk management. I would also add that our throughput from our retail gas stations is between 35 to 40% higher than the industry average. In our petrochemicals business, this has really been an outstanding quarter. As I said, EBIT at 3,417 crores is up 35% year on year. It's the highest in our history. EBIT margin at 15.2% is also probably the highest in the industry and is certainly among the best in the global context. In the various sectors, we had the integrated cracking and derivative margins continued to be strong and improve. Integrated polyester margins were stable. And as far as our production is concerned, we were 8%, we were 8% higher in production and 10% higher in domestic sales. So higher volume along with better domestic absorption also contributed to margins. Production growth was the most in PTA and PET, where we have brought new capacities online. In our cracking business, polyethylene deltas were stable. Polypropylene deltas were slightly softer as propylene prices were higher than what we had seen in the previous quarter. But PVC margins were outstanding and again at an almost cyclical high. In the polyester chain, we saw strong demand growth for PET. We saw stability in polyester margins as demand continued to follow the gap between cotton and polyester prices. Let me now talk about upstream. This continues to be a difficult business for us. EBIT continued to be negative at 491 crores. Production in India at 23.5 BCF, our share was down 10% quarter on quarter as we managed declines. In our shale gas business, volumes were down 7% quarter on quarter. As you know, we are not drilling in any of our joint ventures in the shale gas business. So this is also a natural decline of existing wells. CBM testing goes on, and we are testing both the production facilities as well as the pipeline. Moving on and talking about our retail business, as I said, we gained significant traction in this during the quarter. Revenues are up to 8,079 crores, up 63% year on year. EBIT margins flat, but EBIT was 162 crores in this quarter, up 42% year on year. We continue to expand our footprint. We now have 3,442 stores in 679 cities. Our footprint is over 13 million square feet. And our own smartphone brand, LYF Life, is among the top 5 brands in India. And Agio, which we launched recently, is now among the top 5 apps in its category. Retail is a growth business for India and for us, and as you can see, it's gained significant volume and margin growth in the past few quarters. That's the update for this quarter. I really appreciate all of you listening to me, and I would take this opportunity to wish you all a happy Diwali. Thank you so much.